Welcome back to Renegade Investor Academy. In this episode, I want to touch on one of the biggest questions and challenges for investors, I think, throughout the 2020s, which is to say, are we heading for inflation? Because the choices we make in our investment portfolio can be often driven by our view of whether we're broadly heading into inflationary or deflationary times, because some assets will perform better in a period of inflation, others will perform better to protect your wealth in a period of deflation. But like a lot of things in the investing world, it ain't that simple. I've asked a lot of very smart people this question over the last few months, and it's a little bit like lining up 25 economists. You'll get 25 different answers to the same question. That's pretty much been my experience. So what I want to try and do today is just talk you through some of the parameters that will influence whether we're getting inflation. I also want to talk about two critically different types of inflation, because what we're seeing happen today, and I've said this many times before, is a great big experiment. And I don't think anybody knows how it's going to end, including the people who are ostensibly driving this experiment. So let's just talk through some of these factors. And I want to start by going back to 2008, to the previous kind of financial crisis, because what happened there was that we had the first real rumblings of QE, money printing, quantitative easing by central banks. But of course, we didn't actually have inflation, partly because a lot of that money went into the retail banks who'd been most badly hit by the global financial crisis. And let's be clear, a lot of these banks came within a whisker of failing. And there was really only very, very prompt action by the government and the central banks to bail them out. And we can have a long debate about whether they should have done, whether that was the right thing, or whether they should have been left to die the miserable death they deserved. But they were bailed out. And they just kept that money to repair their balance sheets. And rather than, if you like, coming out publicly and saying, we've got 186 gazillion pounds of underperforming, terrible loans, they just gradually, over a period of years, used the new money to effectively overcome the impact of those non-performing loans. So 2008 was all about repairing bank balance sheets. This time it's different. They entered this latest COVID-induced crisis in a much better state. They've had tighter capital adequacy rules to comply with. They've had a chance, obviously 12 years now, to repair their balance sheets. So they've come into this in a much stronger position. So now, when the central banks start giving them more money and also giving money to governments, then that money has more of a chance of finding its way into the real economy, because don't forget, what these banks do is create new money. When you go to them to ask for a loan to buy a car or to extend your house or something like that, they're not taking Mrs. Smith's deposits and handing them to you to give to your garage or your builder. They are just putting some numbers into a computer system and creating that £10,000 loan out of thin air. So that is new money that is created by the banks. So as long as they're doing that, and of course at the moment they're doing it at quite low rates of interest, then that money can find its way into the real economy. What they're also doing is underwriting government spending. So they're buying effectively government bonds so that the government can spend the money on whatever it wants to do. Now we're getting close to this thing that you heard mentioned called modern monetary theory, where it seems like certainly if you have your own currency, like Britain or America, but unlike, say, countries in the EU, you can keep printing it and keep creating it at will. And then the politicians can keep spending it as they want to do. So this year, America has been quite incredible, quite unprecedented. Depending on whose statistics you believe, $3 or $4 trillion worth of new money has been added to the Federal Reserve's balance sheet. In Europe now, the European Central Bank has agreed to a 750 billion euro stimulus program. Our own Bank of England, again, doing fresh QE, creating new money, new stimulus. And the Fed, of course, has even gone further. with direct purchases of things like bonds and ETFs. There's only really one step left, which is to copy the Bank of Japan and start buying shares and equities directly in the market. Now, I have a huge problem with that because it's such manipulation of the market that I no longer know what a fair price for those things is. Before the government got involved, it might have been at this price. They then add all this liquidity to the market. Suddenly the prices do that. And they talk about infinity QE, infinity Fed. They will do whatever it takes for however long it takes to sustain not just the economy, but also the stock market. And the key point for us today to understand is that that kind of money, that kind of stimulus creates asset price inflation. That's why stock markets just keep going up and up and up. You've heard all this talk about why is the stock market so disconnected from the real economy? People are losing their jobs, people are furloughed, shops are closing. How come the stock market is still reaching new highs? Because it's being artificially inflated with this central bank money. So the people that already own the assets, and that's not just stocks and shares, it's bonds, it's real estate, they're seeing those asset prices go up, which makes them as investors very happy. What we're not seeing so much yet is consumer price inflation. This is the price of the stuff you buy in the shops. Now, there has been some inflation, particularly in areas like food prices, but on the whole, we live in a very low inflation world with technology, with low-cost production countries, keeping the cost of goods down. We've tended to live with very low consumer price inflation for some time. The question really is, at what point does all of this stimulus activity feed its way into consumer prices in the real economy? The feeling is that that is going to happen to us at some point. What we've actually seen is a strange reaction, really. In the first few months of the pandemic, we've seen enormous savings. In America, the savings rate went from 8% to 33% in April. Now, it's trickled back down to about 13 or 14%, but it's still close to double its long-term average. So people were getting these $1,200 checks from the government, and they were just saving them. Or sometimes they were spending them on stocks and shares. They were investing through their Robinhood accounts or whatever. So we actually had a very deflationary response from the public. They started paying down debt. The same thing happened in this country. I think something like £8 billion was paid off credit cards in the first few weeks of lockdown. So people's immediate reaction was, I don't know where this is all going. This is very uncertain. I'm going to be ultra cautious and conservative. So I'm going to take advantage of the fact that my costs have come down, because even if you were furloughed, you might be getting 80% of your salary with no commuting costs, with no lunches to buy, with no clothes for work to buy. So people were realizing that they were a bit better off. They had more money in the bank at the end of the month, and they were saving it. They were paying off credit cards. They were being ultra cautious and conservative. Now, those are deflationary activities. But what we think is going to happen next year, eventually, when we come through all this in 2021, there's going to be this splurge of spending. That new car, those new clothes, that new furniture, that new TV, that new iPhone, all the things that have been pent up during 2020, I've now got money in the bank, I've got savings, I'm at some point going to be allowed to go shopping again. So, hey, we're going to have boom time in 2020, so it could 2021, so it could appear. So maybe next year, particularly as the vaccines take effect and people start to feel safer, they'll be out there doing some shopping, buying some new bits and pieces and triggering inflation. But of course, the other side of all this is what's happening in the business world. Now, obviously, a lot of businesses have suffered a terrible 2020. If you're in the hospitality, leisure, travel sector, your business has been decimated. And even as we record this, it's not clear when things could get back to normal. How long can those businesses survive? Are we in a kind of a phony war period where furlough and stimulus loans and SIBLs and bounce backs have kept a lot of businesses alive? Are they going to survive another lockdown post New Year? Are they going to get through to Easter or the summer or the autumn whenever the vaccines take effect? There's a lot of pent-up worry and a potential collapse and insolvency in the business world. We've also seen, I think, real rethinking of global supply chains. One of the things that became apparent, obviously, was that goods could not move around the world so freely, and suddenly all these just-in-time factories practically ran out of parts. So car assembly lines, anything that involved importing things from, say, China, suddenly there was a problem. There's also been political pressure to become more self-sufficient and less reliant on foreign governments. So there's an element of reshoring, of bringing things back, even if it's a bit more expensive. The certainty of being able to produce it and get it delivered is seen as potentially more valuable. But of course, that's going to have an inflationary effect on factory prices. So what we could see is a reduction in global supply chains, more things being made locally at higher prices, triggering inflation. So what are the kind of consequences of all this for us as investors? Well, if we believe that inflation is coming, then obviously there are certain kinds of asset that are a good place to be. Gold would be an obvious one as a hedge against inflation. Physical assets like property and art are also very good. Stocks and shares up to a certain level of inflation can do very well, and then they can start to do not so well if inflation becomes more rampant. We could even see, of course, stagflation, which we had back in the 1970s, where you've got prices going up, but you're not actually seeing GDP and economic activity improving. Now, we're going to be coming from a very low base in 2021 because things declined, I think, faster than any time since 1709 in 2020. So we did lose, I believe, 7 or 8 or 9% GDP. So there's a very low base to start from before we're going to trigger inflation. That gives us, if you like, some capacity to do more without triggering consumer inflation. We've already seen a lot of asset price inflation. That will probably continue as long as all the stimulus does. But what I think we're also going to see is a potential improvement in the value and the prices of commodities, which have had a terrible time recently. They tend to be cyclical anyway. Normally they're about 28% behind the sort of equity markets in terms of a lag. Recently, they've been more like 100% behind. They've been hugely behind. So commodities are in the worst position they've been relative to the stock market, I believe, for about 100 years. So as an investor, there's definitely an opportunity there to get in on the whole commodities boom. That obviously includes metals, industrial metals, precious metals. It includes agricultural products. It includes energy-related products. All of that kind of stuff is potentially going to be in more demand, because what we've seen is during the last few years, the amount of investment in producing new commodities has gone down, and then demand will go up, but the supply is restricted, and therefore the prices go up very quickly until they start producing more of it, and then the prices will come down again. That has always been the history with commodities. So chances are we're now at the lower end of a curve that's going to suddenly see those commodities go up because of constrained supply and increasing demand. Eventually that will reverse, as it always does, but it looks like we could be at the start of a multi-year bull market in commodities, which of course itself will then feed into consumer price inflation. One of the people I respect enormously is Russell Napier. For many years now, he's been an ardent deflationist. He felt that we were getting into a situation where prices were going to keep going down. But in 2020, he came out and said, that's all about to change. I don't believe I'll be sitting here talking about deflation again in my lifetime. I think we're in for 40 years of inflation. Now, it's going to be a slow start, and the nature of inflation is it's almost imperceptible at first. It creeps up behind you, you don't see it coming, and then suddenly it's there. And I speak as somebody who lived through the 1970s with 20+% inflation. And you start getting 2 or 3 pay rises a year just to try and keep up. Your mortgage rate is some obscene figure, and prices are going up faster than you can shake a stick at. And don't forget, everything the government's doing with stimulus is going to be to try and get you to spend and not to save. So what happened in America in 2020 with those stimulus checks was not the script at all. People were meant to go and spend them into the real economy and try and improve and increase GDP to counter the deflationary impacts that we were seeing. And governments and central banks hate deflation, which is actually good for consumers because it means prices are going down. They want to trigger inflation, mainly to reduce the impact and the servicing cost of all the debt they've created. So what you're going to see is governments and central banks trying to trigger inflation. I know it hasn't happened in Japan, but there's some unique circumstances there that perhaps make it slightly different. What I suspect we're going to see is a continuation of asset price inflation, as we've already been seeing for some years, and a gradual increase in consumer price inflation that will suddenly become apparent perhaps around the middle of the decade. So as with all good, smart, savvy investing, the time to get your planning is before these things happen. So if I were you, and obviously the usual caveats and disclaimers, we can't give specific investment advice, we can give guidance. The guidance I would suggest is to assume we're going to live in an era of continuing asset price inflation and increasing consumer price inflation driven by the very things I've talked about with the supply chain and the commodity cycle. That's all for now. Join me next time for another Renegade Investor Academy.